All right, everybody. We are pretty much ready here. Pooh said he is in. I just saw him a second ago. I think he's going to. There we go. I do see Pooh. Let me go ahead and send you an invite. And let's get started ASAP. Oh, it's like showing him coming in and out on my screen. Do you see him, Evan?
I did half a second ago, not anymore though.
All right, let me just send him.
Oh, he's back. I see him.
Okay. Here's the prayer that this one also. No technical difficulties. Nothing like that. All right. I'm all plugged in and everything. So, all right. I went ahead and I shot him an invite. We did get this to work last time, so I know that there is hope. Let's see. In the meantime, I'm going to go ahead and I'm going to share out the space as well. If anybody else is able to interact with that, that would be huge. I just shot you a message, Pooh. If you can hear me in the audience, go ahead. I just shot you a DM. And if we want to communicate in there just to get you up here, that would be perfect. But basically, you just have to be on mobile, on a cell phone. And if you request, there's a little request button, or whenever you go to join the space, if you restart Twitter or something, it should just tell you that you're a speaker since I've shot your request. So it should give you the option and just go ahead and join right off of that. So it shouldn't be.
Oh, Wolf.
Yeah.
While we're waiting here, guess what? Kathy's trades just came out. Guess what she bought?
She bought Zoom, didn't she?
Well, actually, yes, she did buy Zoom, but she also bought Tesla.
Oh, look at that. Buy the dip. Now I feel even worse about my position. Okay. All right. I see Pooh DMing with me. So, let's see. Are you? All right. I'm working it out. Don't worry, everybody. We're gonna get him up here. It took us a few minutes the last time. What we did was we did a test the last time. He said, I only see listen live join. Try. All right. You want to tell me what those other trades were, Evan, for the minute while we're getting Pooh up here?
Yes, sir. I got you. So Kathy Wood trades literally just came out. This is instant before I even got the tweet out. So Tesla bought about 15,000 shares of that, about 0.1% of the ETF. I do want to go in and check if that makes it the largest holding. But again, after we know that Roku overtook that. But besides that, she bought some Zoom. And then C Limited and RK, and then in RW, she bought some Coinbase, which we know has been getting destroyed. She was a little bit more active in ARKG. A lot of, genomics names in there that don't get as popular traction on FinTwit, but I know a lot of people do like that ETF. But she also bought some Coinbase and ARKF as well. So buying Tesla was the big move in ARK, but she also added a little Zoom and Coinbase today as well.
All right. Nothing that surprised me in there. Okay, so I think the problem. So I'm going back and forth with Pooh. I just think that his Twitter app might need to be updated real quick. So we're gonna get him on. Sorry for the delay, everybody. I definitely want to bring this space to you. This was one of our best spaces of the year when we did it in Q1. Hopefully, we're able to get these Q2 problems. We just did a bunch of spaces as well today, and we didn't have any problems. So I don't think. Hopefully, we can get this solved before too long. But real quick with that Tesla piece. So how much Tesla did Kathy buy?
I'm going to do the quick math right now. She bought 15,858 shares. So give me a second. Let me get the calculations. And I want to see if it is the largest holding, because before today, Tesla slipped to the third largest holding behind Roku and Zoom. Now, she added to Zoom as well in here. So I'm sure that it's actually kind of looking like Tesla will not be the largest holding still, but it's definitely going to be inching closer. Let me do a quick little math here. So she probably spent about $10 million on her Tesla shares today, about that, which would put it still going to be the third largest holding. So we are post Tesla being the largest holding of Kathy Wood, although across all three of her ETFs, all six of her ETFs, what am I saying, combined, it is still the largest holding up there.
What's the number one holding right now?
It's Roku.
Wow.
There is a chance it might move with her buying Zoom and then the upwards move in Zoom. There might be a chance. I'd have to look at it, but
That would be pretty crazy, yeah. So one more time to everyone in the audience, I'm going back and forth a little bit with Puru in the DMs. Goal is definitely to get this started as soon as possible. Maybe we should have done a test run. Last time we did a test run. Now it's been about 4 months since we did a space together. It's also the morning by them, so I think he like recently got up. I think it's maybe 9 a.m. now in Hong Kong, something around that time. So he is joining us from across the world. So there's a couple different moving pieces here. Regardless, we're going to make it happen. We're going to get the content going. It's been about 5 minutes, a little bit back and forth. Let's see. Hey, Evan, is there any chance that Kathy selling Tesla and then rebuying it is considered a wash sale there?
so the month it's a wash sales for a month. So I would think no, that we're good with it. And I would listen. I'm gonna say I hope we would be able to avoid a wash sale at that point. I think that's a fair statement to make. So I'm gonna say no, but I guess in 2022 anything could happen.
Yeah, that's pretty fair. Okay, so I've just been seeing like Puru like popping in and out of the crowd. He's telling me that there's new speaker button. I think it's again something to do with the app just being updated right now. So dropped an invite to one or two other people that are in the audience just to kind of pass time for a few minutes. Hopefully we'll get them up any minute now is really my hope, and we kind of get rolling with this. We just talked market sentiment for about an hour on the last space. So otherwise I would roll right into our own market sentiment topic, but we just did a whole bunch of market sentiment. We had like 350 people on there. So I definitely want to get a little bit of a different perspective. In the meantime, I'll also put this out there because I ended up taking a ton of questions from the crowd last time. If you do have a question that you want to ask Puru specifically, you can go ahead and be like, hey, this is for Puru or something along those lines and throw that into my DMs. I think that would be an easy way to be able to get that type of stuff over. Maybe I'll put out a post too. That's what I did last time. There was like a whole bunch of stuff just blowing up around this last time. So let's see. All right. Going back and forth. I'm hoping he gets back to me any minute. I don't think it usually takes very long to update the app here. All right. I also dropped, let's see, get one or two other people. We can just talk stocks for a minute while we're passing time. No other way around it. But yeah, I think it's pretty interesting. Tesla down at 657. So maybe perhaps there is a good entry point here, although now I feel like it's going to plummet. So we'll see which way it goes. What's Jim
There's a
Cramer's
lot.
Tesla?
Oh, there we go. Just about to come with stuff. See, we got Puru up here.
There we go. Okay, perfect. Puru, can you hear us?
Can you hear me?
Loud and clear.
Perfect.
Perfect. Was that the app update? What was going on?
Yeah, I don't know what the problem was. I've managed to log in now. So
Love to see it. Okay, I'm going to go ahead and just let everyone know, put out a tweet that we are live. I'm going to ask them, if they have questions or anything, they can put it under that. If you're able to either share that or share out the space, that'd be perfect, and we'll get rolling. All right. Join us on Space Time. So, Puru, while I guess I'm putting this out, we can go ahead and just kind of ask you the question to get started. I want to maximize your time. I would love first, our last space was back in Q1. We did it in early January. Since then, we've had, 4-ish months of just selling. We've seen the indices come down to near recession points. And that was one thing which you really called out in our last space. You talked about, hey, I think that a lot of these growth stocks have already sold off 50%, and some of those are up, 70 to 90% at this point. But the industry
have to print a Google Drive.
Wolf, I think we're having a couple technical difficulties, but unless that's just me.
What the hell? God?
Evan, can you hear me?
Now I hear you, yeah.
Oh my God. And the Wolf account's going to glitch out on me right when we get this started. Okay, Puru, can you hear me?
yeah, I can hear you.
Okay. So the Wolf account glitched on me, so I'll just switch phones. All right. The question that I was asking there was, last time we did a space, it was back in Q1. It was January, and the indices were still holding up relatively nicely in comparison to a majority of growth stocks.
essentially during this period over the last 4 months since we did the space, we've seen a 15 to 20% drop in most of those indices, nearing bear market territory. Growth stocks have dropped off another 20 to 40%. How have you felt and approached the last 3 to 4 months in the market, and where's your current sentiment on indices?
Yeah, basically the indices have had a pretty brutal sell-off over the last few months, and the growth stocks have absolutely been smashed as well, as you just pointed out. And I still think the selling, especially at the index level, is not over yet. We've had a big sell-off already. But if you look at the forward PE ratios of the NASDAQ and the S&P, they are still trading roughly 20% above the prior bear market lows since the global financial crisis. So if you look at the PE ratio, the forward PE multiple on the S&P in the global financial crisis and the GFC bust, it bottomed around 9 or 10. In the 2000 and 2002 bear market, it bottomed around 14. And then in 2011, when we had the European debt crisis, it bottomed around 12, if I'm not mistaken. And then in 2015 and 16, when we had the 20% or odd bear market in the NASDAQ, it bottomed around, I think, 15 or so, 14, 15, 15. And then when we had the quantitative tightening in 2018 in December, when Powell basically did a U-turn just around Christmas, the forward multiple on the S&P had gone down to around 14 or so. And then during the COVID crash, we also went down to around 14 or so on the S&P. At the moment, the S&P is trading at a forward multiple of about 17. So we are looking at another 20% decline from here for the S&P. And bear in mind that, in the prior bear market lows, the Fed basically reversed policy very, very quickly to stem the decline and to basically get the animal spirits flowing again. This time around, the Fed's hands are tied, unfortunately, because of very high inflation. So it is conceivable that the Fed will have to see at least a 20% decline before it pivots again. We are starting to see signs of that because there was one Fed official, I can't remember his name, who just came out a few hours ago and said, in September we might pause because the 2 rate hikes might be sufficient. But if you look at the economy is weakening very, very rapidly. Autos have peaked, the housing market has peaked, and Snapchat announced material deterioration or deceleration in their business, in the advertising business. So all the signs are there. I think the growth stocks have been smashed already. As you said, they're down 70, 80, 90%. I mean, I had no idea that they would fall so much. I was expecting a 40, 50% hit, not a 70 or 80 or 90% smash. I mean, this crash is on par with the global financial crisis. And it's even worse, I would argue, for good companies, because back then only the banks which were impaired went down 90-odd%. The rest of the stocks went down maybe 60, 70%, 50% before they bottomed and rebounded. This time around, the crash in technology has been spectacular, and I think it's one for the history books. And this one, I think, is even worse than the 2000-2002 crash, because at least that basically took 2 years to play out, and there were some big bear market rallies to actually get out. This time around, there has been no opportunity apart from one relief rally to actually close positions. So everybody is trapped, and everyone's hoping for a rally. But we haven't really seen true capitulation yet, in my opinion, because if you look at the put-call ratio for the equities only, that is not above the 1 level. And if you look at the prior bear market lows, or each time the put-call ratio for the equities spiked to 1.1, 1.2, this time around we're still hovering around 0.8. And also the VIX really hasn't gone parabolic yet. So I think the true capitulation lies somewhere ahead, at least for the indices. What the growth stocks will do is anybody's guess. I mean, I think they've gone down so much already. I would be very surprised if they go down, more than the indices at this point, but who knows?
Okay, great points to start off with there. You can hear me through this account? I'm back on this one.
Yeah, I can hear you loud and clear. Can you hear me all right?
Yes. My sound I cut out for a couple minutes there, and I'd gone to the other phone, but we are back and rolling. So, okay, yeah, I absolutely listen. I have much shorter time period than you, so especially coming from you, it means a lot that this is historic. What's happening right here. Real quick, just a question for you. I'd love to get your audience into here. I have pinned up top, if you see it, a post in the nest. I can also DM it to you, or if you go into the space, there's a little blue plus button. If you're able to share this out on your timeline, and to anyone in the audience that's able to share this out, so there's either that link pinned up top or the blue plus button. That's how we'll go ahead and get your audiences into here. But love to get a lot more people into here. We only get you on these spaces every so often, Puru. So I want to, and this last one got
Okay,
60,000
just
people.
just bear with me a second. Let me just tweet this now. 1 second.
Perfect. Yeah, this last one got actually 60,000 people ended up listening to it. So never hurts. And
1 second.
yeah. And also on that same post, for anybody in the audience that has questions, last time we got hundreds of questions that came in.
Okay, I've just sent it out.
Perfect. Okay, so now I kind of want to talk to you a little bit about valuations, which have come down significantly. Are tech? I know you're a big tech investor. Are some of these valuations getting to points where you're starting to feel comfortable adding? Have you been adding over the last 3 to 4 months? Are there specific names that stand out to you as more resistant than others?
I mean, to be honest with you, I feel a bit foolish even saying this because, I called the whole thing. I saw the carnage coming. I did not see the extent of this carnage. And foolishly, I've been buying too soon. So, I mean, my drawdown is pretty awful at this point. I think my account is down maybe 30% year to date. And this is despite hedging. So, it's been absolutely brutal. I mean, and with the benefit of hindsight, it would have been better for me just to, hold cash. But, as I said, I had no idea that these stocks and these companies would go down 70, 80, 90% in terms of their market caps. So coming back to your question, I do think a lot of these growth companies are very, very washed out. I mean, the valuations are at multi-year lows. Some of them are at all-time lows. If you look at the operating results have so far not really shown any material impact based on what's happening at the macro level. I think that the operating results are going to weaken over the next quarter or two because monetary policy always works, but with a lag, so the effects on the economy become evident a few months out. After the Fed does its thing. So the market has certainly discounted a lot of this weakness, which is now unfolding. And a lot of these companies are now extremely cheap. But the problem is when you have this kind of panic, which takes place periodically in the marketplace, valuations don't really mean anything. When we were going up after the QE boom, at the end of the QE boom, a lot of these companies were trading at 30, 40, 50 times forward revenues. And at that point, when I was saying that this is getting absurd, the stocks don't go up 4, 5, 6x in a year, and these valuations were crazy. They kept going up and up and up. And now the reverse is going on because the Fed, which has basically created booms and busts over the last 100 years, spectacularly, is now creating a ginormous bust by abruptly withdrawing all this liquidity, and liquidity drives the economy, liquidity drives the markets. So when the Fed is easy and basically is handing out the booze and the drugs to everybody basically, consumes the drugs and booze, and everybody gets high and gets very giddy. And then when things go out of hand, and when the reverse happens, when the Fed removes the punch bowl and the drugs and booze are taken away, then everybody basically falls over. So we are now at this stage of the cycle. I think what will happen in the next maybe a few months or so, maybe 2 or 3 months, we are going to see a true capitulation at the index level where the VIX will absolutely go parabolic. And we are going to see a massive fear in the marketplace with the put-call ratio spiking over 1.1, 1.2, that sort of region. The forward multiples on the S&P, in my opinion, will come down to around 14, 15 or so, which is 20% lower from here. That, I think, will get the Fed's attention. And at that point, inflation will be down, because if you look at the history of the Fed funds rate and also the CPI, without fail, over the last 100 years or so, whenever the Fed has embarked on a serious monetary tightening cycle, the CPI has always peaked and come down drastically. So I think it's only a matter of time before inflation rolls over. But before then, I think we are going to see a serious panic and fear in the stock market, at least at the index level.
What do you expect that to look like, that serious fear? Right now, we have SPY sitting right on top of, I use Anchored VWAP a lot, basically just that average price that people have been buying at since the March lows. We just bounced off of that, and it's looking pretty rough if we go below that. Q's in a pretty similar position. Those are both down, I think, roughly 18 to 20% from all-time highs and, pretty recent all-time highs. What's your expectation? So you're looking for more downside there?
Yes, I think the S&P is going to come off to maybe around 3,400. I think the NASDAQ 100 might actually come down to around 10,000 or so. So I think we are basically more than halfway through this bear market, but I don't think we've seen the lows yet because there is still a lot of buying the dip which is going on. Every time there's a sell-off, you have a massive dip buyers come in. People on Twitter are still saying I'm buying, and serious amounts of cash is still going into Cathie Wood's ETFs. And usually the retail punters, they don't buy at the lows, they capitulate and sell. And that's why I think, at least at the index level, we haven't seen the worst yet. I think there's more to come. The growth stocks are a different story. If interest rates, the long-term interest rates peak here and start rolling over because the economy decelerates and you have, inflation sort of starts to abate, then it is conceivable that these long-duration growth stocks, these long-duration assets, might actually show some relative strength. And we've actually seen that over the last 10 days or so. Because if you look at the S&P and the NASDAQ, they actually broke briefly below their mid-May low, whereas the ARK ETF did not. And a number of the growth stocks are still holding above the mid-May lows. So it is possible that these long-duration assets, these secular compounders, may actually start showing some relative strength, especially if the economy weakens. And a lot of these companies which are dependent upon the economy, they start feeling the heat. Whereas if you look at the companies which operate in the software space or in the e-commerce space or even in the fintech and payment space, they are sort of more insulated from the the zigs and zags of the economy. And if interest rates start rolling over at the long end, then I think we might see some sort of strength, relative strength in the growth stocks, but we'll see. I mean, I've been wrong before, so I wouldn't be surprised if I'm wrong again.
Okay, well, let's talk about how you're going to approach that. You were pretty candid with year-to-date performance, and now, coming at this point, right, you expect further downside. So I'm very interested in how you're going about hedging and other perspectives. And also, I do see multiple people requesting, well, I'm not bringing people up to the stage right now because I ended up having technical difficulties with that last time we did it on a really large space, and there's over 1,000 people on the space. My DMs are open. Anybody can go shoot me a DM, or even better, if you want it to be asked first, just go comment it on my last post. Pin post, comment questions you'd like on there. Happy to go ahead and then take any of those and throw them Puru's way. But yeah, Puru, how are you setting yourself up to capitalize now and return to that positive area off this further downside?
Well, I was hedging with ARK, and as I said, despite hedging, I'm still down about 30% year to date, which is, the worst drawdown I've experienced in a number of years. And I'm not happy at all with my own performance and lack of patience, if you will. But I am where I am. And I was hedging up until now with ARK because ARK was the poster child of this bubble. But ARK has already crashed, it's already down 80%. So it's very difficult for me to hedge by short selling ARK when something's already down 80%. So what I am doing now, I'm long my stocks, but I'm actually shorting the NASDAQ index futures as a hedge. So whatever my long exposure is, I'm shorting 150% of the long exposure to hedge my book because I think there is more pain ahead. I mean, we might get a relief rally now and again, but I think unless we get a real washout for the valuations at the index level and we see capitulation and a spike in the VIX and the put-call ratio for the equities spike, I think the path of least resistance is still down. And I think I have a fairly good idea now as to why we haven't really seen more pronounced rallies and longer rallies, because between 2020 March and up until sort of February, March this year, for 2 years, the Fed pumped $60 billion of new money into the system by buying bonds. And that was an unprecedented monetary easing. And also, the government sent so many checks to everybody else, and that's why we had this parabolic run, this mania in equities. And the Fed has basically gone from doing unprecedented QE to stopping that within 2 or 3 months, to raising rates, and now also, planning to do the QT, which is a reduction of its balance sheet. So this monetary tightening has been severe and very, very abrupt, and it has basically followed a 2-year period of unprecedented easing. So that's why, things have become so crazy in the markets, because we have had a huge amount of easing and monetary stimulus and fiscal stimulus for 2 years. And they've gone from basically withdrawing that abruptly within 3 or 4 months. And now they're jamming interest rates higher. And also, the market is forcing the Fed to act, because the 2-year yield on the treasuries has actually shot up to about 2.5, 2.6, 2.7% recently. So 260, 270 basis points. And the Fed usually just follows the 2-year treasury yield. So we've gone from QE to rate hikes, and also QT starting in June. So I think the amount of monetary brakes which the Fed has applied is pretty severe, given how loose the financial conditions were. And that's why we are seeing this rapid decline in all risk assets, not only just stocks, but also cryptocurrencies. Crypto is down 50, 60%. Bitcoin, the other stuff is down even more. Some of the junkier stuff has blown up, and junk bonds are selling off. The credit spreads are widening. The US dollar is getting stronger. So every single thing that you see during liquidity contractions is now taking place. And I don't think we've seen the worst yet. I think there's more to come.
Okay, so with all that in mind, right now you still are, you did post that tech valuations are at lows, especially, multi-year lows. I know you're interested in that sector among others. What's currently your highest conviction stock idea?
At the moment, in terms of conviction, I obviously feel favorably towards all the companies in my portfolio. But as I said, it doesn't really matter what I think about any company or the conviction, because if you do have, a liquidation climax or a selling climax, all the fundamentals get thrown out of the window. Nobody cares about multiples or what the business is doing. And the absurdity of what is going on is pretty evident. A Snapchat came out a few hours ago and announced that they will not be able to meet the revenue target for the next quarter. And the algorithms just crushed the stock by 30%. How do you hedge against that? You just cannot. And we've seen this sort of crazy reaction over and over again over the last few weeks from a number of these companies, where they've either announced inline results or even beat. But the market has found any reason whatsoever to try and find something negative to pick, a hole in some particular metric, and the stocks have been crushed. So when the companies have been announcing very good results and they're beating, the stocks have been popping maybe 5 or 6% for a day. And then, the liquidity withdrawal is so intense by the Fed that, everything is just coming down and deflating. So, what I have in terms of conviction is kind of irrelevant. I think people should be more worried about, protecting the downside from their portfolio by either going to cash or hedging or doing whatever they can to stem the decline. Because I think, if the index comes off another 15 to 20% from here, growth stocks may come down more, they may come down less. I don't really have an answer, but fundamentally, I don't really see anything wrong with any of the companies in my portfolio. But in times like these, the fundamentals don't really mean much.
Perfect. Okay. Yeah, absolutely. Fundamentals are getting killed right now. Appreciate all the questions coming in. A reminder, you can drop them in the DMs, or if you want me to go to them first, just drop them on my last post that I put out, the one asking for questions, because my DMs are getting a little crazy here. All right, but I'm going to keep at it, looking through these. All right, so I'm curious. Typically, you have actually, before we talk about portfolio updates, I want to talk a little bit about overarching macro. So, I think a lot of people are looking for signals here to signal some type of bottom, some type of reversal. So I'm curious for yourself, what type of leading economic indicators are you looking at to signal either economic deterioration or perhaps recovery? And will they also signal you as to, perhaps there being a bottom, or would you need to see these signals combined with a shift in Fed policy?
This monetary policy is the horse, and the economy and the markets are the cart. The Fed pulls the economy in both directions. And if you need proof, all you need to see is what happened between 2020 March and the first quarter of 2022. Everything was hunky-dory. The stocks market was flying. Economy was strong. That's because the Fed was easing. And now the Fed is tightening. And the monetary policy, as I said, always works, but with a lag. So the monetary policy is now very, very tight. And the tightening is getting more severe because of QT, which is coming next month. So I think for the next quarter or two, at least for the next quarter, unless the Fed reverses course pretty quickly, I think the economic surprises are going to be to the downside. And I think given the valuations and given the amount of leverage in the system and, the margin debt and everything else, I think we will have to see a policy shift from the Fed to put in a sustainable low. As long as the Fed is still fighting an inflation and it is basically not really that worried about the economy. And Powell has recently said that, the priority number one right now for the Fed is to crush inflation. And they're not too bothered about the economy. And they've said that, in the process of killing inflation, if we do get a hard landing, so be it. And there is more pain to come. So the Fed is telling everybody what's coming down the road. And if people are not paying attention, that's, up to them. But the Fed has been pretty clear that they will do whatever it takes to, stop this inflation spike. And I think they're serious because if they don't act, they're going to have a serious backlash from the government in the US. Tens of millions of Americans and people all over the world are struggling to pay their bills. There is a serious crisis going on for food and energy and stuff. People are just unable to meet their monthly bills and payments and so forth. So, if the Fed has to crush the financial markets for a period of time to bring the inflation genie back in the bottle, then I think the Fed will do whatever it takes, because otherwise, if inflation keeps surging, then the first thing to get shot will be the Fed's credibility, and nobody wants that. So I think there is more pain to come. I wish I was a bearer of better news, but in this business you get rewarded for being realistic, and I think there is more pain ahead. I may be wrong, but all the stars are aligned for now. Where I think apart from bear market bounces and relief rallies, which may suck everybody in, I think, the next major shoe to drop is still somewhere ahead.
Okay. And yeah, a lot of people on the timeline are commenting, and I think you touched on this, about the upcoming QT, right? How we're experiencing this type of situation, but we haven't even touched QT yet, which I think starts in June, July area. And at that point, right, we're tightening. We're not just, sitting in this complacent state. So is that kind of where you expect that further drop to begin?
I think so, because you have to also bear in mind that in the prior bear markets, since the turn of the millennium, 22 years now, whenever the market fell 20 odd % and the economy was weakening, the Fed started easing. So this is the first cycle in a very long time where the Fed is not only not easing, the Fed is actually tightening into a decelerating, weakening economy. And, the Fed is still tightening and hawkish despite a 30% knock in the NASDAQ and a 70, 80, 90% hit in the growth stocks. So this is not a normal cycle. I think the Fed put still exists, but I don't think the Fed put exists at these levels. I think there would have to be more pain. There would have to be a deflationary impulse in the economy for inflation to come down materially before the Fed is able to pause at least, and that would trigger a massive rally, I think, in the back half of the year. I think the minute the Fed signals that they are done for now, they are pausing on rate hikes, or the QT is on hold, any good positive news on the monetary front, and I think these growth stocks will double within a matter of 2 or 3 months. So I don't think people should be selling these growth stocks now because they're already down 80, 90%. I think it's better just to grit your teeth and just focus a year or two out. I know it's very difficult to do that when your account's going down 6-7% every day, But the problem is the minute the Fed basically sends a whiff to the market that, they are considering taking a pause or a breather for rate hikes or QT, and the economy is getting weak and they are getting worried about the economy, that would be the signal, I think, where the market will basically bottom. And a number of these high-flying, high-beta growth stocks, which have been unfairly, unjustly crushed because of what's going on at the macro level, they will basically, double within a matter of months. So it's going to be, I think, another 2 or 3 months of pain, perhaps maybe a month or two. I don't really know how long this is going to go on for, especially for the indices. But I think there will be a Fed put maybe 15, 20% lower from here. And when the Fed signals the reversal, everything's going to take off and we are going to see the mother of all rallies over the next sort of 15 to 18 months.
Well, let's touch on that even further out. Let's say we bottom this year. What do you see for the next 5 to 10 years?
Well, I don't really know what's going to happen over the next 5 to 10 years, but I can tell you fairly, with a good degree of confidence that when the Fed does its pivot, and it will, because otherwise they're going to implode the economy. So the minute they actually come out with some sort of dovish commentary or they do some sort of pause or bullish or sort of a dovish pivot, I suspect the stock market will bottom. And a number of these growth stocks, which are now trading at 5, 6, 7 times revenue, they will basically go back immediately within a matter of weeks to 10, 12 times revenue. And we are going to see a big rally over the next 12 to 18 months. And after that, we will have to see what the Fed does. But I think we are going to see a very sharp rally as soon as the Fed does its dovish pivot.
Okay, another question that came in. I believe that you mentioned the U.S. dollar is getting stronger at one point there.
That's right.
So, at what point would you expect the U.S. dollar to begin to stabilize? And what's causing you to forecast a stronger U.S. dollar?
The dollar basically is a barometer of liquidity in the economy. So if you see when the Fed is easing and interest rates are low and the Fed is accommodative, the dollar declines and everybody has the carry trade. Everybody borrows in dollars and speculates in commodities, in stocks, in housing, in foreign currency, high yielding emerging market bonds and so forth. And when the Fed basically removes the punch bowl and everything becomes tight and interest rates start going up, then all these loans have to be repaid. So what people do is they panic, then they start selling their assets in all the emerging countries all over the world. They start repaying the dollar-denominated debt. So what they have to do then is they have to sell their currencies in the emerging markets and everywhere else. And then they have to sell the assets, and then they have to buy the dollar to repay the debt. And when you buy the dollar, what does the dollar do? The dollar gets stronger. And that's why we've seen this massive run-up in the dollar over the last few months. At the moment, the dollar is hovering around the 104 level on the US dollar index. And I think it'll be very interesting to see what it does after this consolidation. If the Fed really is serious about tightening, then I think we are going to see another leg up in the US dollar, and that would be even more problematic for global liquidity. Global liquidity will tighten further, and that would, I think, cause the next leg down in the indices. Because if you look at valuations, which I keep coming back to, valuations don't matter at all when the Fed is easy and the music is on and the music is playing. But valuations do matter when the Fed basically has, stopped the music, if you will. So if you look at the prior 20 years of history, you will see that the S&P bottomed around 14 or 15 times forward P. And assuming that the earnings don't actually come down this year, if earnings just do what the analysts expect them to do, which is also uncertain, then you're looking at a 15 to 20% decline in the S&P. So the dollar basically is a symptom of global liquidity. It tends to weaken when liquidity is abundant, and it tends to shoot up when liquidity is tight.
Got it. So looking at it as a measure of liquidity there. Perfect. Okay, a couple others that came in here. Some people, I guess there's some more broad topics to touch on here. One of them is, similar to, it's not like U.S. stocks are special, but Chinese stocks have been hit pretty hard as well. You can look at names like a Futu, like others, and these kind of started taking the jump even earlier in the year. A lot of them around June, July, I think, when Baba started making that move. And they've come a pretty significant way down. Are you currently holding any Chinese-based companies, and does it factor into your decision to hold them or not?
I don't have any exposure to Chinese companies anymore. I sold out of all my Chinese companies maybe 2.5 years ago, and haven't invested in any Chinese companies since then. In my opinion, I think Chinese companies have become uninvestable simply because of the political risk and also the regulatory risk and the threat of delisting them from the US exchanges. So again, I'm not here to give advice to anybody. I'm not a registered investment advisor. I'm a retired investment manager. But from my personal point of view, I think there is too much risk to own Chinese ADRs simply because of all the reasons I've mentioned. And also, most people don't even realize that if you invest in Chinese ADRs, you don't actually own shares in the actual company. You own shares in a variable interest entity, which is a VIE, which is an offshore company, which has some contractual agreements with the underlying actual business in China. So due to regulation and policy set by the Chinese government, they don't allow foreign direct investment in a number of industries and sectors. And the way they've found to get around this to attract capital is they take the money, but they don't give you shares in the actual companies. They give you shares in the offshore entity, which is the VIE. And according to the Chinese constitution, the VIE is actually an illegal arrangement. So shareholders who own ADRs are effectively at the mercy of the Chinese government. If they decide one day that they don't like this type of arrangement, then they may very well ban this overnight and say, well, we don't recognize the VIE, and investors are going to lose a lot of money. So this is just an extra added level of layer of risk, which I'm not prepared to take with my capital.
Got it. Yep, that definitely makes sense to me as well. So I pulled up the current portfolio, or the one that what it was at April's end, and a couple of these names stick out to me. I'd love to maybe just touch on these top three, and then we can kind of go from there. I've had a specific names sent to me as well. Some people asked about them. The first one was one which I wasn't so familiar with, which was ADYEY. I think that these are laid out in alphabetical order. They're not by highest. So that's just probably there because it's A, but I'm curious if you want to speak to that one for a second.
Sure. I mean, Adyen is basically a payments business from Holland. They do a lot of business with enterprises. So they basically are effectively the payment rails for the modern day world. And not only online payments, they also enable these enterprise customers to accept payments, both, point of sale as well as e-commerce. And they have a unified tech stack, one platform, which makes it very, very easy for these enterprises to accept payments from all these different markets by simply one plugin from Adyen. And Adyen also does risk monitoring and so forth. And the revenue growth has been pretty fantastic. The business is profitable. They generate a lot of free cash flow. The management team is fantastic. I've been a shareholder for a couple of years. And I think the valuation now, in my opinion, has come down to a fair valuation. It was pretty overvalued up until last year or so, up until 6 months or so. But now it is trading at a 1.5 times PEG ratio. So I think for a high quality business, which generates a lot of free cash flow and the management is fantastic, 1.5 PEG is fair. But it doesn't mean it can't get cheaper, because if you do get true capitulation over the next few weeks, which I expect, then I think this may come down a lot more. So just because I'm discussing companies, people shouldn't go and rush and buy those stocks today. But Adyen seems to be a pretty good, interesting business. It is comparable to Stripe in the US in many ways, not exactly identical. But, if you are looking at payments-related companies, which enable these big merchants and companies to accept payments from all over the world. And I think most people would agree that e-commerce is not going anywhere. More and more humans are spending more and more time online. So I think payments on the internet are going to become more and more popular over the next 5-10 years. And I think Adyen is a fantastic business which will benefit from this transition.
Perfect. What do you say to those that point out that growth stocks are still historically expensive at these, multiples?
Well, depends on the company, because if you look at a lot of the companies, like Twilio, Okta, they're trading at 6-7 times year-end revenue multiples. If you look at Affirm was down 90% from top tick to bottom tick. It has recovered somewhat, but it is still trading at 6 or 7 times trailing 12 months revenue. A lot of these companies have gone down 70 or 80%. I would argue that some of the best SaaS companies or the software companies are still, I would argue, marginally overvalued. But by and large, I think valuations and multiples have compressed significantly. And if you look at the software valuations in general, the software valuations have already come down to multi-year lows. I think we may get some more residual selling over the next few weeks. But by and large, I would argue, given the growth runways, given the higher gross margins and so forth, and the free cash flow generation ability, at scale, I would argue that the growth stocks, which have already been smashed 70, 80, 90%, are a lot more attractive now than the index, which is still, only 20 or 30% of its highs. And another observation that I would like to make is that, when we had the market topping, when the Fed removed liquidity, the growth stocks were the first to top. So, what happened was in the early 2021, the ARK ETFs peaked, the IPOs, the SPACs, they topped, and then the junior growth stocks topped, and then the mid-cap growth stocks peaked, and then the indices rolled over. So I think when the Fed does basically signal a dovish pivot, or even before, as soon as long-term interest rates start sliding, it is conceivable that these growth stocks may actually bottom before the indices. And the reason I say that is because if I've done a lot of research over the last 20 years, managing money professionally for investors and also for myself, and I've seen that in every single major bear market, the most prominent, the highest quality growth stocks bottomed several months before the indices. And in the case of the 2000 and 2002 bear market, the TMT bust, most people don't realize that Amazon, eBay, Priceline, which is now Booking.com, all these companies, they bottomed a year before the indices. And the same thing happened in 2008 and 2009 when we had the bust. The S&P made a new low in March 2009. It fell to 666. A number of the leading growth stocks of that era, they bottomed in November 2008. So about 5 months before the indices. And then by the time the S&P bottomed, they were up 100, 200% already from the November 2008 lows. And something similar happened in 2018. In 2018, the software companies, the Twilios, the Oktas, the MongoDBs of this world, they bottomed in October, whereas the indices bottomed in December. So if history is any guide, one can make the case that a number of these growth stocks may actually bottom before the indices. And it is too early to say it with any degree of certainty, but a number of these growth stocks are already significantly above the mid-May low recorded a couple of weeks ago, whereas the indices are flirting with those levels. So already we are seeing some relative strength in not all, but many growth stocks.
Perfect. Okay, I have a couple more interesting questions that did come in. One of them is, we know that the Fed, right, it's a pretty tough job trying to rationalize, right, lower inflation, higher inflation, moving back and forth in between. At this point, is it at all the Fed's interest to engineer a bit of a pseudo recession to kind of calm things down? Do you think that's kind of anything in their mind? Obviously not to, plunge us into the dark ages or anything, but to try to hit a bit of a reset button here as they realize that, all the money printed and everything else may have not been the best idea.
Well, I think they're not doing this on purpose. They don't want to crash the economy. I think they have to bring inflation down because this is a question of credibility. If inflation runs at 8% and the Fed says, okay, we are done now, what do you think is going to happen? The bond yields are going to go parabolic. The long-term bond yields are going to jump to 4.5%, 5%, 450, 500 basis points. And that would be a serious problem for the US government because at the end of the day, whenever new debt is issued, the government has to, pay the interest. So I think they have to bring inflation down. And if the economy crashes and burns, that is just an unintended consequence of bringing inflation down. They've telegraphed what they intend to do very clearly. And if investors don't want to, listen to what the Fed chairman is saying over and over again, and if they're in denial, then, that's their problem. The Fed is not concerned about the stock market. The Fed is more concerned about inflation and unemployment. That's the two metrics that they go by. Unemployment right now is still pretty low. Inflation is still very, very high. So, logically, they are coming after inflation to try and bring it down. And in the process of doing so, if unemployment goes higher and the economy struggles and the stock market goes down, well, people who own shares will have to live with it. What they're more concerned right now is, to put food on the table for the tens of millions of Americans and all other people all over the world who don't even own stocks. For these families, life has become untenable because the prices have spiraled so much over the last 12 to 18 months that people are struggling to pay their bills. So I think that's why the Fed is determined to bring this inflation rate down to maybe 5 or 6% at least before they start doing some sort of dovish pivot. And I think at the rate at which the economy is actually decelerating, I wouldn't be surprised if the CPI comes down to sort of 5 or 6 handle within the next 2 or 3 months.
Perfect. Okay. I'm getting a lot of people asking about this reverse repo, so I'm going to phrase a question around that. A couple of people also asking me about the recording. Like many of my spaces, this one is recorded on Twitter, so you can go ahead and as long as you're following or the Wolf Counter, you're basically checking out my posts, you'll be able to see I'll share recording afterwards. However, I also do have somebody in the audience that is recording this and is going to upload it to YouTube, Spotify, Apple Music, all the good platforms. So with that being said, if you want to see those as well, I will post that out afterwards. It's usually up within about a day, maybe like 24 to 36 hours. So I'll get that out there. So for anyone that's, dying to have that, you're going to be able to get it. So it is no worries at all. And yeah, just make sure easiest way is if you're following the Wolf account, you'll see that on your timeline. All right, let's ask about this reverse repo right now. Recently hitting all-time highs, looks like about 2 trillion in there. What's the implications of that and why should people be paying attention to it?
Well, rather than the reverse repo, I think it's more important to pay attention to the Fed's balance sheet. And if you look at the Fed's balance sheet basically peaked about a month ago and it's not growing any longer. And if the Fed basically carries through with what is said, and if it starts, shrinking its balance sheet by doing QT, then I think that's going to tighten financial conditions even further in the near term. Personally, the reverse repo is interesting, but I actually pay more attention to the Fed's balance sheet because that aggregate number is more important than what the Fed does in any individual market, in my opinion.
Okay, that sounds good. All right, there was another question, and this one a little bit more complex, but I think you'll probably understand better than me. They were asking about the cross-currency basis swaps. So their question was cross-currency basis swaps are widening. You can see that there is a massive shortage in the wholesale dollar funding market. They don't believe that the issue is the U.S. economy, but that it's contagion risk abroad. And they'd like to get your opinion on that.
Well, this is something which is seen every single time the Fed tightens policy. And, as I mentioned earlier, when the music is playing and the booze is flowing and the drugs are being handed out, everybody takes on dollar-denominated loans and debt, and they borrow at next to nothing, and then they invest the money in assets overseas, in the emerging markets, in high-yield debt, and so forth. People buy property. All sorts of madness takes place when free money is being handed out to people, and when the liquidity tightens, then you have this mad scramble to pay back dollars because you have to pay back the debt. Otherwise, the margin clerk comes and knocks on your door and wakes you up in the middle of the night. So, you have to sell your foreign currencies. You have to sell everything, whatever you can get your hands on to repay your loans, which are denominated in US dollars. And that's why what we are seeing now, we are seeing a mad scramble for US dollars. The liquidity flows have reversed. And as long as this debt is being extinguished and the margin debt is being paid down and people are becoming risk averse, I think the dollar will basically have a tailwind. And all these are just symptoms of a strengthening dollar and tightening liquidity and a tightening financial condition.
Okay, perfect. A couple other macro areas people are coming in on. One of them is the housing market. There's a lot of interest in how maybe the repo is going to affect that, how other areas, and just essentially general thoughts on this housing market, which has been on quite the run over the last couple of years.
Housing, in my opinion, is also going to peak. If it has not peaked already, housing starts already down. All the data is suggesting that the best festivities have already been seen in the housing space in the US, and I think I would argue in most other parts of the world. And I don't know how much the housing market will decline, but if history is any guide, I think prices are going to soften over the next few weeks and months. Because if you look at the 30-year mortgage rate, the 30-year mortgage rate has gone above 500 basis points in the US, which is a massive amount to pay for any new homeowner or home buyer. 500 basis points or 5% interest rates on a 30-year fixed rate mortgage is no joke. And I think that will actually cause demand destruction. People are not going to feel comfortable taking a 30-year fixed rate mortgage at 5% in the US. I don't know what the rate is at the moment, but I saw recently that it had climbed above 5%. So it is, again, a function of liquidity. When monetary conditions are tight and the cost of borrowing is higher, housing is the first one to basically feel the effects, because housing is a highly levered asset. So I think, there is going to be some pain in the housing market also in the US, unless the long-term interest rates come down and the Fed again starts, greasing the economy. But I think for that to happen, we're going to have to see a decline in the CPI print.
Okay, perfect. All right, a couple other questions. A lot of questions, obviously, around inflation. Figured I'd throw a few more of these out there. One question from SoFlo is, energy and food shortages are adding to inflation. How can the Fed start becoming dovish with shortages dominating the market? They can only do so much. Would this lead to an L or K-shaped recovery versus a V-shape?
Well, I mean, I will leave the shapes of the alphabet to the economists. I don't know whether it's going to be K or L or W. Who knows? But I do know that as the Fed, clutches the economy even more and squeezes the economy even more and stops the flow of liquidity, commodity prices are also going to crack. They always do. Commodity prices are the last ones to crack, but when they fall, the crash is pretty spectacular. I wouldn't be surprised if the price of oil comes down, 30-40% over the next few months. I mean, the only thing which is keeping this price where it is the conflict which is going on between Russia and Ukraine. But at some point, there will be sufficient demand destruction and weakness in the economy that the price of oil will come down pretty dramatically, along with other commodity prices. And one thing I have learned from painful experience in this business is that commodity prices, whenever commodity prices are the last man standing and everything else is burning around it, it is only a matter of time before commodities and the related stocks also get shot. So, I wouldn't urge anybody to overstay their welcome in the commodities space. It has been a fantastic run. I think as conditions tighten over the next few weeks, commodity stocks and commodities are also going to come under the pump. So for those who are long commodities and the related stocks, it may not be a bad time to take some cash, if not all of the cash, off the table.
Do you look at all? I'm curious at insider data that's happening with a lot of these companies, especially some of these tech companies. One of the things that's been confusing to me, or not confusing as we see the drops continue, is the amount of insiders that are selling their own stock as it's plummeting these levels. One thing which I saw today, which I really want to double check on, but seems like insanity, was for Snapchat. It just didn't look like any insiders had bought any Snap over the last 2 years. Yeah, that actually, if you look, there was just selling the entire last year. So I was just curious if you see that as something throughout the area and if you pay attention to that at all.
I mean, I do keep an eye on it, but it's not something I look very, very carefully. I mean, when the insider buying really spikes, that is usually a bullish signal. But as I said before, unless we get a dovish pivot from the Fed, all this is sort of noise. These are all secondary indicators. The real problem why we are facing this, deflation in the asset markets is because of the policy from the Fed. I don't think insider buying is going to change it. The CPI has to come down before the Fed can pause, and I don't think we're there yet.
Okay, I want to pull a couple more names from the portfolio to ask you about just thoughts on how they progressed. One of the ones which we talked about back in January was PLTR, I believe. I'm curious, with PLTR, if you can talk to potentially any ads that have been made, just any thoughts here with the stock, which still seems to have this veil a little bit, this cloak of mystery around it, and so many people vouching for the fundamentals, but continues to trade sideways.
Well, after the earnings were announced, I actually sold my position because I was pretty disappointed with the guidance. They claim to be a high growth company, and they claim that their software is unique, it's changing the world. They are light years ahead of competition. But if you look at the execution of the business, they've guided for 25% revenue growth for the next quarter. That doesn't instill me with confidence. And also, despite complaints from shareholders, the share, the SBC, the stock-based compensation, isn't really coming down materially. And Palantir may do well in the long run, but I don't think it's in the top tier businesses as far as I'm concerned. They do have a pretty unique offering, but it is quite a lumpy business because they don't have thousands and thousands of customers. And from what I can tell, they do get a lot of big deals occasionally, and the customer count is pretty slim. And if they cannot grow their business at this stage of their life cycle at even 30% a year, with the so-called life-changing, world-changing software offerings, that to me is a red flag. So I've basically cashed out and invested my money elsewhere.
Okay, perfect. Let's talk cryptocurrency for a second. When we were chatting last, let's take a look at where Bitcoin was. This was back in January. I think back in January, it was having a bit of a dip. Yeah, when we last talked, it actually had been coming down, and then it made another push, but it's come down further since. It's sitting at about 30K right now. The rest of the ecosystem falling as well. I don't know if you looked into at all this UST Terra Luna situation that happened recently that costed about $60 billion to investors as well, but clearly it's just been a tumultuous area. I don't believe you have any exposure to this. Do you have any thoughts on cryptocurrency here?
Yeah, I've thought about shorting it a lot, but I don't have it. I don't have the courage to do it. But cryptocurrency was promoted and marketed as the next best thing since sliced bread. It was supposed to be a safe haven. It was supposed to be an inflation hedge. It was supposed to be real money. It was supposed to be everything. But all Bitcoin is and cryptocurrency is a high beta speculation on liquidity. That's all it is. So when liquidity is flowing, Bitcoin and other cryptocurrencies, if you can call them that, they basically go through the roof. And when liquidity tightens, they basically come down a lot. And, the strength which Bitcoin has shown is impressive, but I don't think we've seen the lows yet. I think, if history is any guide, we are going to test MicroStrategy's margin call level, which is about 21,000. I think the market will make sure we get down to at least that level to tease Mr. Michael Saylor. He was a big proponent of Bitcoin. The market now knows that at 21,000, his company is going to have some problems. And, if you look at the previous cycles for Bitcoin, Bitcoin has actually fallen 85% without fail in every single secular bear market or a cyclical bear market. And I don't think we've seen the lows in crypto either. I think Bitcoin is going to go lower. And it is a speculation, nothing more, nothing less. If you want to speculate with a small percentage of your money, 2 or 3 or 4% or 5%, and if you don't really mind losing all of it, or seeing 90% declines, then fine. But if you are looking at cryptocurrency as your savior, as something which is going to save you from whatever you think ails this world, I think you're going to be disappointed. And before the crypto bulls jump on my comments and say, well, growth stocks are also down 70, 80, 90%. Yes, that is true. They are down, but they're productive assets. They are real world businesses. They sell services and goods and products to the rest of the world. They've got management teams. They've got employees. They've got real world revenues and cash flows and so forth. Some of them are profitable. In the case of crypto, you have no productive asset. It doesn't do anything. It doesn't produce anything. All it does, it basically bounces up and down on a screen every day and gets people excited or disappointed, depending on where you're on the cycle. So you cannot really compare cryptocurrency to companies. I know growth stocks are down right now, and so are many other companies. Amazon is down 50% or so, 40-50%. So the carnage has not been limited to crypto, but at least in the case of companies, you have real world businesses and assets backing your shares in the company. In terms of crypto, you have absolutely nothing.
Okay, perfect. All right, let's take a look at a few of these other questions. All right, we have some personality, more questions coming in. I got a question from Greg in the crowd. Puru, are you a fan of Oreos, the cookie?
Oreo cookies. I mean, who doesn't like them? But I don't eat them.
Okay, who doesn't like them? That's what I'm saying. All right, there's the question for you, Greg. I hope you were here for that. All right, another question, which I thought was a pretty good one. It feels like when everybody's talking about valuations nowadays, they just automatically go to PE, but it doesn't feel fitting for all companies and has become a little distorted lately. Are there any other metrics that you commonly use to value a company's share price?
I mean, you can compare it to price to revenues, EV to revenue for software companies. You can look at the the free cash flows and stuff. I mean, not a lot of growth companies have free cash flows, but you can look at the free cash flow yield. You can look at price to earnings. You can look at EV to revenue and so forth. So there are a number of ways you can do this. If you look at only price to earnings ratios, then you will never ever invest in the truly long run growth companies, because most of them are not profitable because they reinvest so heavily in their business that they are unprofitable by design. So price to earnings multiples are handy to use when you're looking at mature companies or companies which are already profitable. But for the real hyper growth, high growth companies which are still early in their life cycle, I think PE ratio is meaningless. And I know that a lot of these unprofitable companies are absolutely hated by investors right now because everybody is focused on profitability. And I think this is very, very silly and delusional, because if you look at a number of the growth companies before they became profitable, they were unprofitable for a number of years. And a lot of these software companies and a lot of these e-commerce companies and payments companies, they can become profitable tomorrow if they wanted to. All they have to do is cut back on their sales and marketing and be satisfied with the number of customers they have. And if they did that, then a lot of these companies would become profitable. And they are not doing that because they are playing the long game. They realize, if they get these customers, which tend to stay, and then they log them in subscriptions for a number of years, then it makes sense for them to basically spend the money now to get these customers and grab as many customers as they can. So 4 or 5 years out, their cash flows and their revenues and their profits will become a lot bigger than they would if they just stopped looking for new customers today. So if you look at a lot of these software companies like Okta, Twilio, Snowflake, all these companies, Zscaler, CrowdStrike, some of them Datadog, some of them are already profitable on an adjusted basis. But a number of these companies, if they fulfill their promise and they keep growing like they have said they would, and analysts expect them to, and there's no reason to think that they won't, then I think 5, 6, 7 years out, all of these companies are going to be extremely profitable. They will have margins, which will look pretty healthy when compared to your consumer staples companies or, your auto companies and so forth. A number of the analysts that I follow, and I get research from various banks and so forth, I mean, they are basically projecting that the operating margins for these companies are going to, be as high as 20, 25% or 30% in some cases at scale. So, I think it is incorrect and a bit short-sighted for investors to, simply dump these companies because they're not profitable today. It's just the flavor of the month. Everybody's just getting out of growth stocks because they've read in the newspaper or heard on TV that growth stocks are, horrible. Energy and commodities is where you have to, be positioned. You have to own the mature, profitable companies. And these changes in sentiment come and go in the stock market. I've seen so many of them over the last 20 years. And the minute the Fed becomes easy, sentiment will shift again. Money will come out of growth stocks, these mature companies, and go back into these growth stocks. The time to buy these growth stocks is when nobody wants them. That's when you get the lowest valuations. And in my experience, at least, if you go back 200 years or even 100 years, we had some pretty horrific crises in the last century. We had 2 world wars, we had an oil embargo, we had pandemics, We've had all sorts of crises, you name it, and we've had it. And what have stocks done? Whoever had the fortitude and the courage to buy shares of excellent companies after 70, 80, 90% declines has made an absolute fortune over the next 10, 15 years. And I think this crisis will be no different. Those who are able to sift through the noise and hold their own and not get shaken out by what's coming and the near-term weakness, which I think is likely. And these people who buy the shares now of these wonderful businesses which are temporarily marked down, I think they are going to do very, very well. And if you look at the TMT crash in 2000 and 2002, all those investors who basically bought shares in world-class companies after 70 or 80% declines made a lot of money over the next 10, 15, 20 years. And I think this crisis will be similar. I don't think this is the end of the world. These companies are not going out of style. A lot of these companies power modern-day businesses all over the world. Cybersecurity. If the Zscalers or the CrowdStrikes of this world stop offering their services, modern-day business will basically cease to exist. There will be so many attacks, and these companies will basically struggle to even run their operations. And same with the data space, the snowflakes of this world, or you look at some of the other space, is the same thing. And the same thing with payments. If these payment companies, Adyen and stuff, stop performing the function and they don't offer their services any longer, modern day life will cease to exist. I mean, you try and buy something online without a payment gateway like an Adyen or a dLocal or anything like that. It's impossible. You're not going to stuff banknotes in your computer to buy stuff online. You need these technology companies. So I think a lot of this is sentiment. The underlying businesses, in my opinion, remain strong. And if the business really does deteriorate at the macro level, if the economy does really come under the pump over the next month or two, I think a lot of these companies, these growth companies, will start to shine on a relative basis because investors will realize, in a world where most companies are shrinking their top line, their revenue is basically falling year over year, companies which are growing at 30, 40% a year might start to look pretty attractive in that scenario.
Okay, perfect. There's a couple of topics here that a lot of people actually haven't asked on at all. And I think just because you're so involved in this Twitter ecosystem, I'd love to get your thoughts on it. We are now about a month exactly, I think, removed from Elon Musk, the date where it was certified that he would go out and actually purchase Twitter. Since then, a lot has gone on. Twitter's lost a third of its share price. Tesla has suffered. There's been this crash. There's all different things going on. I would just love to get your thoughts on this Twitter Elon deal potential. If you think Twitter is something that's worth, buying from a value perspective, or perhaps if he adds a special touch that makes it worth it. We'd just love to get your thoughts since you're an avid Twitter user.
Well, Twitter is obviously a very powerful platform, but the problem is they haven't been able to monetize it, and it has got so much junk on it. Frankly, it puts me off so many times. I wonder what I'm even doing here, because every time somebody leaves a message for me, there are at least 8 or 10 bots which basically reply pretending to be me and, asking them for money, and with Telegram accounts and stuff. I don't have any Telegram account. I don't even know how to set one up. But, every time somebody tries to, reach out to me, I'm even unable to answer because 7 or 8 bots do that for me. So, it has a lot of problems. It also has a lot of potential. I mean, if Elon Musk wants to own the, mouthpiece of the world, then, who am I to comment? I just think there is a lot of turnaround which needs to happen at this business before it becomes, truly an endearing business, and before it is able to turn around. I mean, Twitter as a company doesn't really excite me very much because their operating results haven't been spectacular. They've been pretty disappointing.
Okay, let's flip it and talk about Tesla here as a investment. So I looked at your current portfolio, and Tesla's not a name that you hold, although it has come down quite a bit in the last 2 weeks since you posted. So current thoughts here on Tesla, or perhaps is there an entry point for you? Is this a company that you're at all interested in, and maybe what you think Elon taking on a whole bunch of different things means for it?
Tesla is a fantastic business. It is clearly the world leader in EVs and arguably also in battery storage, but that is a much smaller business segment at the moment. But my reservation with EVs are twofold. One is that as a business, auto OEM is a pretty lousy, high capex, low margin business, and it is very cyclical. There is no recurring revenue. You have a lot of variables that you have to contend with, including fickle consumer demand. And Tesla did exceptionally well over the last 14, 15 years or so since its IPO, because there was no competition. The other companies were asleep while Elon Musk was basically eating their lunch. But a lot of these companies have now woken up and competition is coming. I know Tesla cars are fantastic. I have a Tesla. I own a Tesla myself, so I know it's a fantastic car. But I'm concerned that there is a lot of competition on the horizon, which is lurking. Rivian, a lot of these German car makers are getting pretty serious about EVs. So EVs are now the future. So, if you put a gun to my head and said, do you want to own shares in a highly competitive, high capex, low margin, cyclical industry? I would probably say no, because I think there are better places for my money. But if somebody is looking to have some exposure to the EV space and they don't mind the cyclicality, which is inherent in the auto OEM business, then Tesla is by far the best option in the EV space, because at least they've got the scale, they've got the technology, they've got the software, they've got a highly charismatic, iconic CEO, at the helm running the business. And they have got, a lot of other advantages, which I won't go into now. So, it all depends on the investor. If one is interested in participating in the EV space, then by all means, Tesla is the no-brainer investment. As far as I'm concerned, I think it's very difficult for new companies to scale and, reach the kind of production which Tesla has been able to achieve. And if you just look at the history of the auto industry in the US alone, I would say 95% plus of the auto companies are no longer in business. They all went bankrupt, and the ones which survived basically survived because of government bailouts. So the industry itself is not very promising. That's why I've actually stayed away from all EVs as far as investments are concerned.
Okay, got it. A couple other questions. These are maybe like house cleaning questions. Someone asked, for those without a Bloomberg terminal, is there a place where you recommend people go to look for analyst estimates, especially 2 to 3 years out? A lot of these companies have investor presentations quarterly and publish projections, but where can people find analyst estimates from bulge bracket analysts? Just seeing if you had any thoughts on that.
You can try Y charts. You can try Coifin. These are the two services which basically put out estimates. I think they do have accounts on Twitter as well. Y charts, YCHARTS, and then you've got Coifin, KOYFIN. These are the two services which do provide analyst estimates. But generally, going out a year or so, the companies themselves guide what they intend to achieve in terms of their revenue. And some companies even put out multi-year targets. So you have to basically carefully monitor the companies that you're interested in or invested in, and go to their investor relations section on their website and keep an eye out on their press releases and investor presentations and events and so forth.
Okay, awesome. There's a lot of questions here around potential that the Fed is faking people out, right? They're kind of bluffing here. And people ask, do we have historical precedents of the Fed removing liquidity of this magnitude? If the housing market's still at all-time highs, are we going to still see QT and other pieces like this, which could potentially cause like a 2008 scenario? Where do you think the Fed is standing from a bluffing perspective?
I don't think the Fed is bluffing at all. I think the Fed has made it very clear that they are going to raise rates. They have started raising rates already. The Fed said that they would stop QE. They've basically followed through on their promise. They have stopped QE. They have announced that they're going to start QT in June and then July and stuff. So I think in order to keep their credibility, they will do QT in June and July, and they will hike the Fed funds rate in June and July by 50 basis points each. And after that, they may be opposed. I mean, if the market implodes and goes down another 20% from here, between now and sort of July, August, then it is conceivable, depending on the CPI print at that time, the Fed might say, actually, I think there's enough damage which has been done in the economy, and we are getting concerned about the unemployment situation in the US, and we are going to take a pause. We are going to wait and see for the next month or two. That is possible, but I don't think the Fed is bluffing. I think people who are still positioned for a bluffing Fed are going to get a rude awakening, because so far, whatever they've said, they've carried through on it. And there is no way the Fed is not going to tighten and bring down the CPI print when it's running above the 8 handle.
Okay. Yep, that's pretty fair. Couple of the names that we touched on beforehand as well. Just want to pull one or two more from this portfolio, where I believe Crowd and Datadog are both in there. Is that correct?
Correct.
Okay. So is Crowd still in there? I didn't see it on the April end update.
No, I've started. The price has actually come down quite a bit, so I've started nibbling on CrowdStrike again.
Okay, yeah. So these are a couple companies. So I'm not sure if you're familiar with Muji. It's at Hypergrowth and Software Stack. So I went to a conference actually with them last weekend and was chatting with them. And they're definitely enjoying the valuation lowering a little bit on these companies. They see it as a strong opportunity now. Can you talk within this data and cybersecurity sector what you're looking for? Because I think that there's this worry and fear that they're just going to ultimately return to COVID lows, which is still a ways down for these names from where they are.
I think the valuations for these companies are still pretty high. They are trading around 14 to 15 times next 12 months revenue, which is still pretty rich. I mean, these are small positions for me right now. And as I said, I'm already hedged by shorting the NASDAQ futures. I think that these valuations will compress even more, especially for these companies, because they are still pretty rich. 14, 15 times next 12 months. EV to revenue multiple is not cheap by any stretch of imagination. I think these companies may come off another 20 or 30% before the dust settles. So these are fantastic companies, but they're still fairly richly valued given where we are in the macro environment and the liquidity cycle. So some more near-term pain cannot be ruled out. But these are fantastic companies. I think those people who keep buying shares as they go lower are going to be rewarded in the future. But I think there are more problems ahead in the next 6 to 8 weeks, in my opinion.
Okay, got it. Yeah, I think that they could have some more pain ahead as well. Can you speak a little bit more to you've mentioned the hedging through ARC and hedging through a couple other methods. How do you size those versus your portfolio?
Well, normally when it is with ARC, I just sell short 1-to-1. So if I'm long $100 worth of stock, I sell short $100 worth of ARKK. But ARKK has already imploded. It's already down 80% from the highs. So I'm reluctant to short ARKK here, which is why I've switched to shorting the NASDAQ futures. And because the NASDAQ futures have a lower beta than my portfolio, the beta is lower, the volatility is lower. So I'm shorting 140, 150% of my long exposure to try and keep me, flat. It hasn't worked in May at all. It's been a pretty disastrous drawdown for me this month. But you live and learn. And all you can do in this business is try your best. And, you sometimes everything works out for you. Sometimes you stumble and you learn from the school of hard knocks. It's just part and parcel of this business, unfortunately.
Okay, absolutely. Yeah, that makes sense to me. All right, so I think we'll probably do maybe 8 more minutes here. There's a couple more questions coming in. We did about an hour and a half last time. Massive thank you to you, Peru. Definitely to take time out of, I think it's the morning there for you, and to come on for a while. I was really, really grateful we got to do this last quarter. I'm excited we got to run it back, and hopefully we'll get a Q3 as well. Hopefully,
yeah, sure. No, my pleasure to do it. Yeah.
With some better times, hopefully. We'll see if we get through a little bit more here with the market. Okay, a couple more questions that I think are pretty good ones that did come in. One of them was, when the Ukraine-Russia conflict began, did you adjust your portfolio? And as it progressed and is still going on, is it something which consistently has affected names that you have had exposure to?
No, it has had zero impact on how I invest and how I manage my portfolio.
Okay. Got it. Another question. There's a lot of there's been this kind of run on stock splits since we last chatted. Amazon, Google, and others looking for these 20-to-1 splits. to try to maybe pull down, interest more retail investors. With these large cap stock splitting, do you have any thought that goes into that? It's kind of weird how it does end up often providing this short-term boost.
Yeah, but they're just trying to find any support they can get in this difficult market to try and boost the stock price, because obviously if they lower the price by 20x, suddenly the stock becomes more affordable to buy for a number of retail investors who don't have, thousands of dollars to invest in one share of one company. So they are obviously trying to expand their shareholder base. I don't think that's going to have any impact on the business itself or on the market cap in the long run, because, if the revenues and the cash flows keep gushing in, over time the market cap will get bigger. If the business struggles, no amount of stock splits is going to, could change the destiny or the future of these companies' market caps. So I think these are just short-term gimmicks. I don't really think they hold much water. I think, if anything, it's just a distraction. In the long run, any company's market cap is ultimately determined by how much cash flow, revenues, and profits the company pulls in.
Got it. One of the items which seemed to be the talk of the town in Q4 last year and even Q1 this year, but seems to have quieted down, is supply chain disruption and supply chain issues. Have those been on your radar at all in regards to any of your portfolio companies?
Well, I keep an eye on them, but given the types of companies in my portfolio, they don't have any direct impact with supply chains, apart from the fact that obviously, inflation has been higher than normal, and the supply chain disruptions have contributed to a higher CPI print. So that is relevant to me from that point of view. But, if I'm investing in e-commerce, payments companies, or software businesses, I don't really see how supply chain comes into any of this, because they don't actually manufacture anything. They don't really have any supply chains. All they do is, they have people and coding and software and stuff, which enables these companies to offer their services to the whole world. So I have not been, or none of the companies in my portfolio have been directly impacted, but obviously everybody has been impacted from an inflation point of view, which has obviously brought down valuations across the board for every company. So from that perspective, yes, I have been impacted by it.
Got it. Are there any other macro events going on worldwide that people should be paying more attention to?
I mean, I would say just watch the Fed, watch what the central banks are doing. Don't fight the Fed. I've been guilty of doing that over the last few weeks, and I've paid the price. I've paid dearly for this stupidity and impatience. I should have waited more patiently for the indices to finish their, implosion or deflation. But the problem is, as I said, a number of these growth stocks in the prior cycles, they bottomed months before the indices. So it's very, very difficult to get the timing absolutely right. I don't know anybody who can get both the top and the bottom, spot on for individual subsectors within the economy. If somebody can do that, at the index level, that itself is a pretty impressive feat. So my timing for reinvestment has been off. That's why I'm facing this 35% drawdown year to date, which has been the worst drawdown for me, and I'm pretty disappointed with my own performance. But we see what each day brings, and we try and survive in this business as best as we can and minimize our drawdowns, and we'll see what the next few weeks bring.
Yeah, we're in a pretty similar position. Definitely been a tough few months here. Starting out, especially from where we were all sitting at November of last year. But absolutely, these discussions are incredible for being able to learn from people like yourself and others. Do you feel, this actually, I wasn't planning on asking this, but one of the questions that we talked about earlier was, how does this feel in comparison to a situation like a 2008, like a 2018, a 2001? Those weren't times where 2018 I was investing, but the other ones I wasn't actually investing at that point. Do you feel like there is a rhythm that is similar to this, or does it feel completely different?
This crash is worse than the TMT crash. This crash is worse than the GFC crash, in my opinion. If you are a tech investor, high growth investor, undoubtedly this particular plunge of 70, 80, 90% in 6 months is unprecedented. Even in the 2000 and 2002 bear market, I remember vividly, I was not actually affected by that at all, because I got out of all equities in, I think, early 2000, and was long gold and long some market neutral hedge funds, and I was shorting the S&P at that period, during that period, so I actually made money during that period. And in 2008 and 2009, the crash was pretty horrific if you owned banks, because banks basically imploded. A lot of them went bankrupt or they were bailed out by the governments. But by and large, companies which were fundamentally sound did not go down 80, 90%. They fell 50, 60, 70%, but not 80, 90%. And the selling was not as relentless as it is now. But the difference between those periods and this period is that during those crises and crashes, the Fed was easing. This time around, the Fed is tightening, and that is the worrying feature of this particular bear market, is that the Fed is basically hiking and tightening policy when the market is already down so much and the economy is clearly decelerating. This is the first instance where the Fed is basically, tightening policy more and more and more, despite a deceleration in the economy and an implosion in the financial markets. And that is why we are seeing this unprecedented, relentless selling in all risk assets, especially long duration assets and the unprofitable segment of the market. So I would argue, if you are a high growth investor in the tech space, in the emerging tech space, or this particular crash has been the worst ever, in many, many decades.
Okay, appreciate the comparison and insight there, and kind of also the story as to what you did during those. All right, just two questions left here. One of them is in regards to the commodities. You just kind of mentioned, having exposure to gold, silver. Another, thing that people are always looking at is oil. Currently, are you using any of these as potential hedges? And also, what are your thoughts in general on oil and gas at the moment?
I think oil and gas have already had their run. They've gone parabolic because of geopolitics and also the money printing which happened before. I have learned one thing from experience and 20 years of doing this, 22, 23 years now, is that whenever commodities go parabolic and the Fed is tightening and liquidity is shrinking, an accident is waiting to happen. You don't have a massive liquidity withdrawal from the central banks, not only from the US, but also from central banks all over the world when they are actually tightening in unison. And you don't have commodities stay at multi-year highs. It just doesn't happen. And I'm saying this from painful experience because in 2007-8, when we had the implosion in the stock market, when the S&P peaked in October 2007 and started going down, and a number of the sectors kept basically making new lows, commodities and oil and gas and stuff, and these companies kept making new highs. And back then, I was obviously not as experienced as I am now. And I thought, this is fantastic, that this is basically the island or the safe haven island amidst the turmoil. Little did I know that there was a rug pull coming in the next few months. And within a matter of weeks, these stocks fell 60, 70%. And I did get caught in that drawdown, and that was the most horrific drawdown of my entire investment career. And that's when I realized, that commodities are boom and bust. They are prone to severe swings in both directions, and they are basically plays on liquidity. And in my opinion, I may be wrong this time, maybe this time is different, but I think it is only a matter of time before commodities and the related stocks also have a massive, de-rating over the next few weeks.
Awesome. Okay, I mean, that's a lot of my questions. One of the questions I had, I asked you this last time. I know that you're, careful with, who you gain information from on Twitter. Following 84 people, familiar with a lot of them. I'm curious for investors, retail investors that are they're coming to Twitter daily, they're looking to intake information, but they want to take it from the right places. Who are a few of the people that you recommend to be following, to be engaging with on the platform?
Well, I don't want to single out people because it's not going to be fair on the others. But, if people are interested in seeing who I follow, then, they can have a look at the people I follow in my, feed, and that's public information. But one thing I would actually like to say is that, when we had this mania going on in 2021, a lot of retail investors and traders, they used to, lurk on Twitter and see what people were buying and selling, and they made a lot of money. Now, when the tide has turned, I see a lot of blame game, a lot of complaints, a lot of hatred, anger, and all that kind of stuff being hurled at other people. I mean, people should keep in mind that when somebody posts on Twitter, like for example, when I post my holdings on Twitter, I'm not addressing that as a recommendation to anybody. I don't even know who reads my Twitter feed. I don't know who follows me. I don't even know what each person's circumstances are. So I think everybody has to take personal responsibility over their own family's finances and their own financial future and do some homework and not just blindly follow what other people are doing, because when things get tough, and they do from time to time in this business, if you don't have the conviction and if you don't know what you own and why you own it, you're not going to have the conviction to own the shares. You're going to panic and you're going to sell. And I would absolutely avoid leverage and margin trading if you're just starting out. Leverage is extremely tricky and dangerous for most people if there is no exit strategy in place. And I would be very careful of these chat rooms and stuff also. There are plenty of them around on Twitter. And always verify a person's background, always verify what the person does. What is the person's vested interest? Are they posting it because they're just sharing information, or whether they're doing it because they want you to, buy the shares that they're pumping and stuff, micro caps and stuff like that. So you just be careful. And, if you're interested in following who I follow and, get some information from, you can do so from my Twitter account. You can see the people I follow.
Perfect. That's awesome. And yeah, obviously everyone should go in and take a look at those. Also, make sure that you're following Peru. I see a couple hundred of you. Oh, it looks like 300 of you have gone ahead and followed Peru during the space. Good choice. I'm following Peru. I've got notifications on. So I recommend you go ahead and do the same. Always some good insights coming out. Regularly shares his portfolio. And of course, my favorite comes on our Twitter Spaces, chats live. Just as a note, I didn't give Peru a single question ahead of time for any of this. This was all off the cuff, live. Questions came in. I fielded them from DMs, from comments, from all of you, and asked them, pretty much as is. So big thank you to you, Peru, for coming on and doing that with us. Stock market news, you here still? I just want to see if you have any questions you want to throw out there, and if not, I'll give Peru, any closing remarks, and then we might just do a couple minutes of debrief after. All right, stock market news, testing 1, 2, and 3. Okay, no worries. You might have been away from the mic for a second. Peru, this was awesome. Really appreciate you coming back on for Q2. Any other closing comments or advice for retail that you'd like to share on this one?
Well, the only thing I would say is, if you have the financial resources to just ride out the storm, I think panic selling at these levels is probably going to be the worst thing you can do. Because if you sell now, you're not going to be able to know when to buy back again. As I said, the indices may come off another 15, 20% or so. Nobody really knows what their growth stocks are going to do. Some may bottom, some may have already bottomed, and it's impossible for anybody to, know with any degree of certainty when a particular stock is bottoming. So as long as you're not on margin, and if you have a long-term mindset, and if you have got cash coming in, this is the time to buy the shares when nobody else wants them, and when everybody is despondently selling. And just, stay focused and avoid trouble. Stay out of debt, stay out of margin trading, and invest in good old solid companies with bright futures, and, learn to live with the swings. If you don't hedge, then you just have to take the pain, because if you want the higher return which equities provide, volatility is the price of admission. You cannot avoid it. If you want no volatility or low volatility, then you have to invest in cash or bonds or something else. Stocks are not suitable for you. But if you want the highest participation in the best performing asset class in the world, then you have to stomach the volatility. There's no way around it, unless you are a world-class trader who can time all the carnage in advance and go 100% into cash. But those are few and far between. For the rest of us, we have to either hedge or take the punches, as they come along the way.
Yeah, great points. And then for those that are dealing with, the downside, the draws, everything like that, and any advice to them in the moment?
I mean, the advice is things always come back. The Fed will pivot. So this is not the time to panic. If you've got the cash and if you have the money you don't need for the next 2-3 years, probably not a bad idea to buy more shares of your favorite companies. The worst thing you can do is get, euphoric after a massive rally and despondent and depressed after a massive crash. And normally, as I said earlier, crashes are buying opportunities. In in the Chinese culture, there is a saying which says crisis equals opportunity. So as long as the companies that you're investing in are not going out of business and they have a bright future and they will continue to grow, times like these are the best times, to have a long-term mindset and buy shares in great companies.
Perfect. Okay. That's going to do it for most of this. For everyone else, you could stay on for a few minutes longer. We're going to do just a quick debrief. One more time, I want to put it out there. People always come in, they say, I missed this piece. I missed this piece. Where's the recording? One, the recording is going to be posted right to my timeline because it was recorded within Twitter. Two, I'm also going to take the recording and I have a free shared public Google Calendar. On that Google Calendar, I put all my Twitter spaces because I have a lot during the week. And I'm going to put the link for this in there. So if you want to be on that Google Calendar where you see all the Twitter spaces that are happening, you don't miss spaces like this one with Puru, like market sentiment, we do real estate, we do all different types. All you have to do is just shoot me a Gmail and I can add you right onto the Google Calendar. It'll send you an email. You'll see the calendar. And anytime you want to reference back to this space with Puru will be in there. But Twitter only stores it for 30 days. So in addition to that, we have someone recording now in the audience, and they're going to help me upload it onto the Wolf YouTube and Spotify. Those links are in my bio. And if you're following also, you'll see them because I'm going to post them out in 24 to 36 hours. Again, 60,000 people listened to the recordings last time. So I'm sure there's some demand for these. Those are going to be the easiest ways to find it. Will be on my timeline. And also, if you want to find those future spaces, Twitter is a brand new feature. It's notifications just for spaces. So I have notifications on for Puru, but he mostly tweets. So I have them on for tweets. It's that little bell next to his name. But if you go to my profile, people come to a lot of my spaces, so you can turn notifications on just for spaces. So just so people know where to find all that. That's perfect. Okay, Puru, great to hear from you. Wishing you a great evening or day. I think it's like 10 a.m. by you. And enjoy, the scene over there in Hong Kong. And we look forward to having you on again soon.
Hey, my pleasure. Thank you very much for having me back on again. Nice to talk to you.
Absolutely. Take care.
Bye now.
Okay, perfect. So for everyone else, we are going to do just a few minutes of debrief here. We might bring up a couple of people just to kind of talk about one or two of the topics that were touched on. I have a couple of friends who are analysts in the crowd. I see SoFlo, I see Danny. I think Danny said you could come up. Dylan, I see you. Maybe you just want to kind of come up and give a few thoughts here while we have a nice audience as to chat to a little bit about, what Pooh was talking about. And if you had any big takeaways. Andrew, you were here the whole time. We'd just love to hear first off, for those who maybe didn't make it the whole time, what were your big takeaways from this? Maybe stuff you agreed with, didn't agree with, any thoughts you'd like to share?
Yeah, so my major takeaway, I'm in a pretty similar boat to Peru, where, yeah, I definitely see that there's a lot of opportunity with these growth stocks that are beaten down by 70, 80, 90%. And yeah, over the past couple of weeks, we are starting to see them show some relative strength versus the indices. And what he was talking about, he just brought up so many good points. And it's just amazing hearing his perspective because he's been through so many market cycles. But yeah, he mentioned, nothing is going to change until the Fed changes pretty much. And I think we've all covered that at length. What I'm noticing is that the Fed, very subtly within the last week, they are starting to blink, at least partially. Where Prue mentioned, it was Bostic earlier that said that they could actually pause in September. And that's literally the first time we've ever heard any sort of rhetoric like that from the Fed since they shifted to this really hawkish phase. So, I think Peru's pretty much spot on, where obviously we're not at the beginning of this sell off, even if it has much more to go to the downside. I think now is the best time to just be doing homework on these companies. So I honestly think it would be cool if we organized a space. And I'm not sure if you already do this, Gav, but just a long-term investing space where a bunch of fundamental analysts come on and pitch here's a stock that's down 90% off the highs that is a pitch to hold for the next 2-3 years or something like that. Do you already run anything like that?
So I won't say that it's specifically targeting ones that are 90% off the highs, but every Thursday at 12 p.m. EST, we do have a Bullish Rippers long-term investing space where we bring on usually about 2 to 3 fundamental investors, and we do have them pitch a stock, one specific stock that they are a fan of, and for them to chat about. So that is one. Also, to the audience, real quick, we do have Andrew up here. It's a pleasure having Andrew on. We do multiple spaces a week. Andrew is literally 54 followers away from 10,000 followers. He's at 9,946. And I don't really want to close this space until we get him to 10,000. I'll do more spaces with people like Puru and other, awesome people within the FinTech world. But y'all have to go and just click in and follow Andrew real quick. It's very much worth your while. I hope that y'all are hearing what I'm saying. I see him. He's taken up. He's only 40 away now. So I recommend, if you haven't already, 400 of you followed me during this space. 40 of you can follow Andrew. So that's what I want to say. But yeah, Andrew, we do that with Bullish Rippers.
Awesome. Thank you so much.
Yeah, absolutely. Danny, what were your thoughts on this space?
So the first thing is, even the best of us get it wrong. Puru was saying that he started to buy too early. And I kept on hearing that type of sentiment with a lot of traders. I felt like a lot of people thought that this was just going to be maybe a little bit bigger of a dip than we've seen. And, we keep on saying it every week. The dip kept on getting dippier and dippier and dippier. And even though he was hedging with those ARK-K puts, it still wasn't able to cover the rest of his portfolio to the downside. So he's human just like all of us are. We're all going up against the same machine. So I thought that was one of my biggest takeaways. The other thing, in which I agree with him, is that there's likely a lot more downside to come. Possibly another, I don't know if you said 10, 20% in the indices. That really jives with what I'm seeing as well. And this could last for the rest of the year. And I think we even mentioned this yesterday. Until the Fed starts getting a little more dovish, I don't see this bear market turning around. And so if that means, not raising interest rates later in the year, if that's what dovish means, then so be it. But as long as they continue to tighten, it's not going to be a good environment for growth stocks. It's not going to be a good environment for tech stocks. It's not going to be a good environment for the general market on the whole. So I think we need to kind of, I think, like I said, the biggest takeaway was him saying, and I applaud him for his transparency. I mean, he's constantly posting his portfolio. He's constantly telling everybody what he does. He's not saying follow him, but he's doing that for his own transparency, which in all honesty, he doesn't need to do that for anybody. But to him to come out and say that he's taken some lumps, being, a 20+ year veteran in this market who has seen multiple drawdowns, and to say this is different, I mean, we all should perk up our ears and really pay attention. I always say this: study the market. It's a bear market. It's hard to trade, but it doesn't mean you should just walk away. Learn. We're going to go through more of these cycles, especially you young people out there. If you're in your 20s, your late teens, your early 20s, you got another 20, 30 years if you want to do this for a living or do it as a full-time hobby. You're going to see multiple types of drawdowns like these. Keep paying attention. Follow the people like Puru who have been through this before. Help to learn the lessons that they are teaching you, and we'll be better on the other side.
Absolutely. And what I'll state is, there's a lot of the reason why we get such a large space when we have Puru on, I know, is not just because everyone loves him. There's a lot of controversy, right? There's love and there's hate. But, I think that there's a lot of people that I disagree with on Twitter that I can still learn pieces from. So appreciate, first off, just everybody in the audience that came and just asked a lot of questions and put thoughts out there and just tried to get answers. You're not always going to agree with what the person says. And I'm personally not the type of person who tries to argue people over to my side. I'd rather just kind of listen, intake, and see what I can glean from it, especially because I'm so early in my investing, journey. People like Danny up here, have a few years on me, and people like Prue for sure, as well, who are even, retired at this point. So I know that, whatever I agree or disagree with, there's always just room to learn. Josh, I see you. I think I see you listening in a lot of our Twitter Spaces. I don't know if you've come up and spoken on one of ours before. We'd love to hear from you if you have something you'd like to share.
Sure. Yeah, this was really interesting. I actually had never heard Puru before. I think I'd seen people reference him, but it was cool to get to hear him talk. I think, like you were just saying, it's really interesting to get to hear people who I disagree with, and I thought it was really interesting hearing his take on what's happening now. kind of being in the eye of the storm. And I'm an oil and gas investor, so I've been at the eye of the storm the last few downturns, and I guess fortunately so far not this time. And I have a different perspective on where we're at from a cycle perspective and kind of what this is most similar to. But it was very interesting to get to hear him talk, and I was appreciative and figured I'd just come up and share that.
Yeah, absolutely. I tried to get your question in there. I think I did. I'm not sure if you were in the room when I asked it. I was kind of looking for you, but hopefully if you didn't hear it, I did ask the question that you posted, and it should be in the recording.
Yeah, for sure. Yeah, I'll check that out. And it's funny, I got to hear him talk. The more I use Twitter, the more I really enjoy it, but also really question the business model. And I think they joke that it's a clown car and a gold mine. And so I have an Android phone. I really like this Google Pixel phone that I have, but it is not very compatible with Twitter. And so I get kicked out of Twitter Spaces a lot. So it's unfortunate, but I was trying to listen, and I think I might have gotten kicked out there.
Oh, yeah. Danny, Andrew, and Evan can definitely testify to my Android struggles. Can you believe, Danny, it's been 5 months since I switched over?
That is crazy. It
Pretty
feels
nuts.
like 5 days ago. Seriously.
I know, it's been crazy. I guess 4 months, a little bit over 4 months. I've been on iPhone now. Pretty nuts. But yeah, no, I feel your pain with it. Twitter does not build for Android. I have a pretty intimate relationship with Twitter. I speak with a lot of their devs and customer support team on a regular basis, and they have very much made it clear to me that they do not build for Android. It's the testing environment specifically is actually very simple on iOS. You can implement code, quickly restructure it, take it out if need be. It's just not the same on Android. A lot of things are much more permanent when you're putting them in. They're not coding in something like React Native necessarily, where it's just going to kind of go to both. I believe they do it separate. So it's kind of probably based on their tech stack, which is probably based on the fact that they started the company 18 years ago or however long it was. So a little bit outdated. But I mean, they're certainly trying to come up. And with Paraga as the CTO, apparently they've been making more moves in that area. So just a couple things. Also, want to give much love to everybody that's in the DMs right now, getting a lot of love. I'm glad people like this space and how it went. I love moderating. If there's people like Puru that you want me to perhaps do a space with, especially if you have a connection and can make a connection for me, that would be huge. If not, I mean, I can always cold DM, but it doesn't always go through. But I'm happy to bring on more people. We've had on, people like Puru. We do ones with Doug Boneparth all the time. Of course, Danny, Andrew, and a bunch of others that are on here. Brian Feroldi, Nick Majuli, whoever we can get on, I'm happy to interview and always chat with. Okay, stock market news. I'll come to you kind of last here. Are you able to speak for a second? I saw you email beforehand.
Yeah, I'm good.
Okay. Any closing thoughts? Any wrap up on that space that we did with Puru? Any takeaways?
Yeah, dude, I thought it was a fantastic space. Love listening in as always. Massive shout out to the main guy, Gav Wolf Financial, the only verified account up here, for putting on such a fantastic space. I can imagine how many hours, not just with Puru, but with everyone in general, Gav spends in the DMs, just messaging people, trying to get them and preparing all this live free content for you guys. So if you do enjoy it, just make sure you're following. We're doing at least 40 hours a week of these live spaces, so follow the only verified account up here to get more of that stuff. Puru's not up anymore, but major shout out to him as well. If you're listening on the recording or something like that, just make sure you're following his account. And massive shout out to Danny and Andrew as well. I'm excited for tomorrow's day of spaces. We have a long day ahead. Danny was with us literally all day, so massive shout out to that. And looking forward to tomorrow.
Yeah, appreciate that. Yeah, these things don't come together so fast. I actually reached out to Puru a month and a half ago to start planning this. So that should give a little bit of time and context. Appreciate the shout outs there. Yeah, we'll definitely be back. Just so everyone knows, tomorrow, let's just give a little rundown on the spaces. We're going to have, I believe, 5-ish spaces. I'll be live at 12 p.m. EST with Stock Market News. Danny and a couple of others will be live charting and technical analysis. If you have specific tickers and you want the technicals, come and we will take those tickers for you and we will chart them. Right after that, at 1:20 p.m. EST, we're going to roll right into a crypto space at 6 p.m. EST because the polymarket space is being pushed to Wednesday. Actually, at 5 p.m. EST, I might be co-hosting a space with the chairman from Wall Street Bets. Keep an eye out for that. That is still in the works. 5 p.m. EST tomorrow. 6 p.m. EST, we're going to talk about DAOs and venture capital. And then 7 p.m. EST, we're going to talk market sentiment with 3 experts. Jay Woods from the NICE,
Ian McMillan, and Brian Lund. So pretty stacked 5 spaces coming your way tomorrow. Again, if you haven't already, go to the little notification button that's next to my name, click that, and you will be able to set notifications for spaces so that you get in the beginning, because sometimes some people speak in the beginning and they, if you're not there, you kind of just miss it. Yes, for those that want charts, you're going to have to come tomorrow at 12 and ask, please. I appreciate the enthusiasm already in the DMs with the tickers. But yeah, and then again, I'll post out the recording, but I think that's everything for this one. Stock Market News, big shout out to you. I know that you were hanging out on this one, but Stock Market News is almost at 200K followers. He's less than 2,000 from there. He is the best account on Twitter to find quick, reliable information on the stock market, world news, and more. So he is right up there next to me. And with that, I bid thee adieu. We'll be back on Spaces at 12 p.m. EST. Follow Danny, follow Andrew. The Gov account's my personal account. You can follow it if you'd like. I post a little bit more on my personal life, my personal trades, things like that from that account. You can check out Super Follows on this account, see what that's all about. And that's it for tonight. Thanks all. We'll chat with you in the morning. Have a great one.